When you buy a home with other people, whether a spouse, a childhood friend, or through a business arrangement, it is a big deal that you have to take seriously. Co-ownership goes beyond a living arrangement, as you would be entering a legal relationship as well. If you're not paying off the home immediately, having a home together will affect how you get financing, your ability to share the property, and what you can sell from the property. Co-buying is not something new, though the share economy is seeing big spikes as of recent. If you're considering co-ownership and you're not sure if it is the right thing to do, this article should help you out. Here, you will find all the right information on co-ownership as well as the pros and cons that comes with it. What is co-buying? Co-buying means more than two or more persons having an ownership stake in a piece of real estate, or when more than one person purchases a property and share the ownership. This agreement can be done between a couple, friends, or a company. There are different types of co-ownership arrangements. Tenancy in common. A tenancy in common, TIC, is the default mode of co-ownership in most US states and by far the most common form of co-ownership. In this agreement, two or more people can have an ownership interest in a property. The ownership interest could be unequal investment stakes with an unlimited number of owners and tenants. For example, an owner with a bigger financial investment on the property could get an 80% interest while two co-owners have 10% apiece. By default, tenancy in common do not have survivorship rights, so if a tenant dies, their stake in the property will be passed to an heir. Tenancy in common is available to every interested party regardless of their marital status. If you decide that the TIC is the best title to property, you and your co-owner should draft a written agreement covering the shares, owner rights to, and responsibilities. In the case of a multi-unit property, the TIC agreement should give each owner rights and responsibility for one unit to create a feeling of separate ownership. Until recently, owners of tenancy in common could finance their property using a single mortgage secured by the whole property. This arrangement could put all owners at risk if one fails to keep up with mortgage payments. Fortunately, lenders now recognize this type of agreement and offer fractional mortgages for TIC properties, giving each owner a separate promissory note and deed to trust. This means owners of TIC would have to qualify for the mortgage separately and can be given different loan terms to choose from. The single mortgage approach is still available for sharing a single-family home and could still be used by owners that don't fancy the fractional mortgage option. Joint tenancy with right of survivorship. Joint ownership divides the share in the property equally among tenants as long as only one person paid for most part of the property. All tenants listed on the deed get equal shares of the property. All tenants will be granted their deeds at the same time, and upon death, the deed will be passed on to their co-owners. To qualify for this type of co-ownership, ownership interest must be granted at the same time for all joint tenants. They must all have equal interest in the property, have equal access and usage rights, as well as same title in the deed. Community property. There are just a few states that offer community property, which is limited to married couples. These states, California, Arizona, Nevada, Idaho, New Mexico, Texas, Washington, and Wisconsin, recognize couples as a single financial entity. This agreement also allows the right of survivorship, which must be specified. However, there is no guarantee of automatic survivorship rights. Pros and cons of co-buying a home. Pros. Co-buying allows you to split the down payment and mortgage payments, making owning a home more affordable. It allows you to start building equity in a home earlier than you would if you had purchased it all on your own. It saves you money on household maintenance expenses. Cons. The co-owner with the lowest credit score will determine the interest rate, which could make the loan terms less favorable. If one co-buyer defaults on their share of mortgage payment, the other co-buyers will have to bear the portion. Some co-ownership agreements allow one co-owner to sell or rent their part of the property without the approval of other co-owners. Should I have a co-owner? If you're deliberating on whether to go for co-ownership or not, you should consider the pros and cons of your decision before carrying on. If you're short on funds or you're not able to get the mortgage for the house you want, co-ownership might make your dreams come through. With co-ownership, the down payment is cheaper and the mortgage payments won't be a burden. However, co-owning a house means you won't have all the privacy you need, especially if you were planning on living alone. Also, the other co-owner can decide to bring whosoever they want to live in their side of the property, giving you no control of your environment. There are also issues with mortgage payment that could arise if the other person fails to keep up. Co-ownership is best done with a spouse, friend, or relative. Tips for how to make co-buying successful. Co-buying is a straightforward process. However, you are likely to experience hiccups along the way if you don't lay out everything in a written agreement. This agreement should detail the obligations and responsibilities of each co-owner as well as the rights each owner has to the property. The agreement should be prepared by a real estate attorney. In fact, you should only go ahead with co-owning a home after you've spoken with a real estate attorney and learned of all the downsides to the agreement. The real estate attorney will draft an agreement based on the type of co-ownership you're going for.